Welcome to this explainer. Look, today we are uncovering a massive, silent financial trap. It's this invisible, wealth-destroying mechanism that is quietly siphoning over 100 grand from young adults before they even blow out the candles on their 30th birthday. We're going to map out the exact collision between your personal bank account and these massive global forces to show you exactly how this wealth just evaporates, and more importantly, how you can build a fortress against it.
Okay, let's dive right into this number, minus $100,000. Now you might be wondering, is this from buying too many lattes? Lifestyle inflation? Actually, no. Young professionals are quietly bleeding this money through a really toxic cocktail of panic selling and missed compound interest. You see, when the markets suddenly flash red, human psychology just takes over, right? Fear sets in, those losses get locked in, and the absolute most powerful wealth-building tool on earth, which is time, is completely wasted.
Which brings us to part 1, the invisible wealth killer.
So why do we panic in the first place? To understand that, we have to look at the invisible strings actually pulling the market. Enter the CPI, or the Consumer Price Index. The U.S. government drops this report every single month, tracking the changing costs of everyday essentials. We're talking groceries, rent, gas, healthcare. It's basically the ultimate gauge of inflation. But here's the real multi-million-dollar question. How does a simple monthly report about the cost of American groceries manage to completely crash a crypto portfolio overnight, literally on the other side of the globe?
Let's move to the next slide and see how this builds into a massive global chain reaction. It goes like this. Step 1, the CPI number comes out, and it beats expectations. That means inflation is running way hotter than we thought. Step 2, the U.S. Central Bank, the Federal Reserve, has to step in. To cool down that inflation, they'll raise or at least maintain really high interest rates. And step 3, making borrowing money that expensive means large investors suddenly want safety. So, big money aggressively exits risky assets.
Let's break that down a bit more. When interest rates are sitting high, institutional investors look at their portfolios and go, why risk it? They take billions of dollars out of highly volatile, risky assets. And yes, Bitcoin, Ethereum, and meme coins sit right at the top of that risk list. They take that cash and move it into safe harbors, like government bonds or just holding cash, which is now actually yielding a decent return thanks to those higher rates. This sudden massive exit of capital is exactly what triggers a market sell-off. But inflation data is really just one piece of the puzzle. What happens when the world just wakes up on the wrong side of the bed?
Let's look at part 2, anatomy of a market crash. Now, CPI is a huge catalyst, absolutely. But sudden global, geopolitical, or technical events are constantly testing a young investor's resolve. Have you ever opened your portfolio app and just seen a sea of red for literally no obvious reason? There's no bad news about your specific investments, just everything bleeding. Well, before you panic, look beyond the screen. Check the macroeconomic calendar. Because U.S. data releases happen on U.S. time, they often hit during the evening or late at night in places like Pakistan or broader Asia. So that massive price swing you're stressing over, it might just be a time zone delayed reaction to a CPI print, not a fundamental flaw in what you're holding.
And then, of course, we have real-world events. Just take a look at this timeline. Recent geopolitical tensions, like the military friction between the U.S. and Iran, instantly created a global risk-off mood. Big investors got spooked and pulled back, causing assets like Bitcoin and Ethereum to take a hit. But then, compound that global macro fear with localized tech issues. For example, users started facing severe lag with the Phantom wallet, which kept Solana artificially stuck at an $80 resistance level. It is literally a perfect storm of macro fear and micro friction. Now, what's really interesting about this slide is the behavioral contrast during these perfect storms. Everyday retail investors tend to panic. They sell off their assets at a huge loss because the daily volatility just feels unbearable. But look at the smart money. Major institutions like Bitmine. What are they doing during these crashes? I'll tell you right now, they aren't selling. They are confidently accumulating assets like Ethereum at a massive discount. They understand the difference between a temporary macro storm and long-term value.
Which leads us perfectly into part 3, the math of wealth.
Let's actually translate these macroeconomic forces into that tangible, real-world $100,000 mistake. And this brilliantly illustrates the point. Consider two hypothetical young professionals, both earning the exact same salary. The one on the left, that's the consistent investor. They hold their assets through all the noise of CPI reports and geopolitical tension. The one on the right is the panic seller. They get spooked by the news, they sell at the absolute bottom, or even worse, they just let inflation eat their cash while racking up credit card debt. Fast forward a decade, and the difference in their net worth is absolutely staggering.
So here is the mathematical breakdown of that six-figure gap. It is a deadly combination of realized losses, which literally means losing money by selling when the market is down, and the massive, often invisible cost of missed compound interest. Look, by avoiding high-interest consumer debt, keeping your money invested to beat inflation, and letting compound growth do the heavy lifting, you're building a financial fortress. Interrupting that compounding just because a monthly government inflation report looked a little scary? That is exactly how you silently bleed 100 grand in wealth without even noticing.
And this echoes some timeless wisdom from the world's greatest investors. Success in investing isn't about trying to magically predict the exact day the market will drop or pop. It is almost entirely about surviving the short-term noise. It's remembering that a single CPI data point or some temporary wallet glitch absolutely does not dictate the long-term, decade-long future of a solid asset. So the real question we have to ask ourselves is, how do you actually build a strategy to survive it?
Let's break that down in Part 4, your financial action plan.
All right, it's time to transition from understanding the problem to actually executing the solution. First things first, you have to train your brain to separate the signal from the noise. On the left side here, we have short-term macro noise. That's your CPI releases, brief geopolitical standoffs, temporary software bugs. Sure, these dictate the daily price. But on the right side, we have long-term fundamentals. Things like consistent investment habits, technological adoption, and institutional accumulation. These are the true forces that will dictate your wealth over the next decade.
So the crucial point is this. Here is your actionable wealth blueprint. Number 1, always check macroeconomic calendars so you aren't blindsided by scheduled volatility. 2, ignore the daily price swings. Seriously, they are just designed to shake you out. 3, never ever panic sell into a red market. 4, use analytical tools wisely, things like GMGN or DEX Screener in the crypto space, to look at the actual data and volume instead of just reacting to price drops. And 5, invest consistently no matter what the news headlines are screaming today.
The systems of global finance, the inflation reports, the shifting interest rates, they're always going to be there, generating endless daily noise. The smart money uses this noise to their advantage, while the unprepared just let it cost them their financial freedom. Well, you now know exactly how this trap works. Will you let short-term panic cost you your six-figure future, or will you start building your wealth with unshakable confidence today? Thank you so much for joining me on this explainer, and I'll catch you in the next one.